I think that in saving, let's talk about that. Um, there is, I think of savings in tiers. The first tier is to secure your well-being, to own a portfolio of assets that are going to secure your well-being. And then after you have that taken care of, then you can go to the next level, take more risk, and so on. That well-being, that purchasing power, has to be viewed in terms of inflation-adjusted dollars. You know, if you're holding a debt instrument and, you know, a cash-paying instrument, and it gives you a 2% interest, and you have a 5 or 6% inflation, you lose money at 3% a year. So you have to look at that in real dollars. And you have to hold that portfolio in a way that is balanced to any kind of economic environment. And then the way I do it, and I remember, you know, I didn't have anything, and then I start to acquire money, and I start to think, okay, how many weeks do I have, months do I have, or years that I'm financially safe, and what do I hold it in? So, and then, you know, once you got that taken care of, you can go beyond it. And I wanted it in a very well balanced portfolio, that type of portfolio that does equally well no matter what happens. There are basically two big influences on markets. The growth rate and the inflation rate. Like if you know that growth is going to be faster than expected and inflation is going to be higher than expected, you know that bonds are going to go down, and vice versa. So the way I give that as an example. So the way I look at it is there are those two big influences, and then they can, so I have four environments, and each one of them can go up or down. So there are four quadrants that I think of: rising growth, rising inflation, and falling inflation. And I want to have a portfolio that will be 25% of my risk in each one of those, so that I don't have any bias. And so I pick the assets that are going to do well in each of those four quadrants, and I hold them in a balanced way. And I tested that, you know, going back actually to 1900 and so on, and you'll actually increase your buying power. And so you know, that's the kind of thing that I think in the beginning. Then you have to also make provision for, you know, taxes to some extent. So I say, whatever that amount of money is, I want twice as that. So in case it goes in half, and I want to build a portfolio that looks like that for, you know, I don't know, X number of years that I have that. And that's the safe savings. And then when I go beyond that, then I'll take more risk. But I think that being safe, particularly in this kind of an environment, is important. And I would take a perspective of how to do that that's like the one I'm just describing. So there's these four quadrants: growth and inflation. If growth is less than expected and inflation's less than expected, you would like to own bonds. Okay. If it's higher than expected, you would not want to own bonds. Okay. If inflation is higher than expected, you would want to own assets such as commodities and gold and inflation index bonds. If growth is faster than expected, particularly if inflation is less than expected, you'd want to own stocks.